Since last Wednesday, March 8th, markets have tumbled following the collapse of Silicon Valley Bank, the second largest bank collapse in U.S. history. Although most assets have not been hit as hard as Silicon Valley's bank stock, which is now, here's a new word for you, dunzo. They asked me last night, they said, do you want me to leave this word in here, dunzo? And I'm like, yeah, I like dunzo. So Silicon Valley Bank is now dunzo, in case you didn't know that. The financial sector was particularly. Let's take a look at how stocks and ETFs with various degrees of diversification have responded to this event. So we did a study. March 3rd of 2023 to March 13th. It's only 10 days.
Not a long time.
Not a long time. This is not what we usually do, but we felt this was important because we wanted to look at a little mini collapse. We calculated the change in share price and the change in implied volatility for the following assets: the S&P 500, the XLF, the financial sector ETF, and the 7 top holdings of XLF. This is similar to the study we did earlier today, which was a much lighter study. This one's a little heavier. So we looked at Berkshire Hathaway, JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs, and Charles Schwab, which, by the way, we sold the high today.
What can't you do?
What can't you do? Let's go to the next slide. Okay, since March 8th, the SPY has dropped over 3%. Now remember, this is before today. We're up like a lot today, but this is before today because obviously we couldn't write it this morning. So we finished this last night. So it's as of yesterday afternoon. So since March 8th, the SPY's dropped by over 3%, and the VIX has expanded from below its average to over 25. That's an increase of 35% since March 8th. For reference,
big.
It's big. For reference, this is really cool. There have only been 22 times since 2005 when the VIX has expanded from below its average to over 25 in 3 days or less. There's only been 22 instances in 18 years. 17 or 18 years, I don't know exactly how to calculate that. So as you can see here, the price change in the S&Ps, this is over the last, this is the price change in the S&Ps since March 8th. And you can see S&P's down 3.4%, and the implied volatility change is up 35%. Look at XLF. This is the crazy sector here, but as a sector index, it's down 9.5%, and the implied volatility change is plus 93%. And we go into individual stocks. I mean, you can see, Berkshire Hathaway, JP Morgan, Bank of America, they were all kind of in a range. Wells Fargo, Morgan Stanley, Goldman Sachs, and then obviously Schwab, which was a complete outlier in this case, because people were confused. Is it a bank? Is it a brokerage firm? Is it a plane? Is it a train? Whatever. But even all these other stocks, compared to the S&Ps, I mean, the financial sector has generally lower volatility, and it just exploded. It almost looked like a mini 2008 all over again, but not quite. Let's go to the next slide. But the funny thing is, if you didn't sell anything right away, like a day, how do you know when the top is? Like I sold it 3 days ago, and they're up money today.
Right, but it was a struggle before that. It was
a struggle.
Sure.
While this is a significant move for the SPY, this is roughly a third the decline in share price and a third of the volatility expansion in the ETF sector. So when we look at what happened, the sector ETF was 3 times greater price move and volatility than the S&Ps. Okay, this is we're just again arguing for another reason to be conscious of your correlation risk. Let's go to the next slide. The top 7 stocks in XLF had varied responses because of how investors perceive the health, stability, and management of these individually. And I think that's obviously what happened to Schwab, and to a certain extent, all these other ones. Everybody was confused. Hey, could the same thing happen over here? We don't know. Let's go to the next slide. So 4 of the 7 companies had losses that exceeded that of XLF, with Schwab the most most notably experiencing a loss of over 30% and a 275% increase in volatility. Unfortunately, for those of us that want to trade at Schwab, the options were not great in there. That was a hard thing to trade,
It
option-wise.
was. The daily options were a little bit tighter.
Yeah, the monthly options were not good.
Yeah, right.
Both XLF and all the single company stocks had significantly higher volatility expansions than the SPY. And I think that's the real takeaway of this piece today is just that everything was, had greater volatility expansions than the SPY. And we're just trying to show you the advantage of, of being very
Strategic
aware
with more than just the strategy, the products that you go into also.
Let's go to the next slide. During financial collapses, such as the collapse of SVB, a single company may respond better than its sector or even the market as a whole. I'm starting to think now, like, you have FTX, you have SBF, you have SVB. Like, everything is done in,
With an S?
no, everything's done. Well, everything's done with just 3-letter acronyms. On the flip side, that single company that may get absolutely crushed was something like in the case of Schwab. But more diversified assets, such as a sector ETF, may not perform as well as specific companies during unforeseen turbulence, but they tend to respond more moderately and predictably than individual stocks. And that's very fair. Let's go to the next slide. So, and assets that are further diversified across multiple sectors, such as market ETFs, are even less sensitive to single company shenanigans. Investing in stocks and sector ETFs is often a great way to get exposure to volatility during quiet market conditions, but it's also crucial to size position concentration appropriately. This is similar to what we did earlier, but you can see here, we looked at the correlation to XLF, and if you do anything outside of XLF for finance, you end up with, a significantly better, diversified portfolio. We're harping on this because it's I want it to be an important takeaway of today's show. And you can see there all the, whether you did real estate or biotech or in this case, utilities, whatever, it just all reduces portfolio risk and even energy and oil and gas and everything else in this. Let's go to the next slide. The takeaways. More diversified assets, such as market and sector ETFs, are much less sensitive to company-specific risk factors. As a result, market or sector ETFs may not perform as well as specific companies during unforeseen turbulence, but they tend to respond more moderately and predictably than individual stocks. And stocks and ETFs are a great way to get exposure to volatility during calm market conditions, but are also crucial to size position concentration appropriately. You got that, Mr. Batista?
I do, sir. I do.
Heavy, but not that difficult. Thank you.
We'll take a quick 90-second break and come back. We got more Tasty Live coming at you. Oh, joy, Mr. Scott Sheridan. Next, Tasty Trade World Headquarters. We'll be back in 90 seconds.